the iBuyers, okay? I like iPhone, iBuyers, right? iPhone, iPad. So think of it like that. And these are these companies that are sort of these internet real estate companies, if you will. Do you care to elaborate on what that means for our listeners?
Yeah, it's this is what's creating all the rage around the conversations that the brokerages going out of business that you and I talked quite a bit about today, and that that's what's fueling that conversation is the ability for someone to go to these different iBuyer platforms. They type in their address with the click of a button. They have a cash offer right there in front of them.
So an AVM, an automated valuation model, spits back an offer, but the reality is it ain't quite what it seems, yet, because that offer will get whittled down a bit. It's maybe not quite as good, but hey, it's better than what we had, because what we had before in the olden days was the primitive thing of the realtor coming out and doing a comparative market analysis. And the interesting thing, though, is you live in Dallas, and what you told me today was shocking. Okay, I don't live in Dallas. I'll be in Dallas next month speaking at a conference, Ryan Moran's conference, my friend. What you told me today was shocking. I'm going to let you say it. I'm not going to repeat it. But the billboards, tell us about that.
Yeah, so if you take the major highway systems in Dallas, you go north, and there's a highway system, 635 in Dallas North Tollway. It's a pretty affluent area. And if you drive just straight north for the first 15 miles from that highway, the vast majority of the billboards, almost every single one of them, are the iBuyers. The ones that are not iBuyers are either engagement rings or a traditional broker tried to keep up with the iBuyers, moving to a flat fee listing, totally changing the way they're marketing the platform. So not only that, but the conversation from the sellers is totally changed. So the normalization of the iBuyers in the market is totally taken effect in several zip codes in Dallas.
So how much market share do they have, these iBuyers versus the traditional real estate companies? And let me just kind of preface what I think this means to investors. You might be listening to this thinking, well, this is just for traditional owner-occupied homes, right? No, it's not. This is very significant because what's happening here is that in the real estate business, there's a fairly high amount of friction. What I mean by that is when you trade a property, you buy it or you sell it, the closing costs are high, the process is rather old-fashioned and slow, and, you put the house on the market, you find a realtor first, you put the house on the market, you wait, then you go through this big closing process, and that's complicated. The amount of friction is pretty heavy in that scenario versus buying and selling a stock, versus buying and selling, precious metals or anything else. There's a lot of friction, right? So the friction is reducing. There's still going to be, even after this disruption that I believe is underway, a lot of friction. But market share and what it means to investors was my question. I go on tangents if you haven't noticed yet.
Yeah, so if you, when we talk market share, there's ways through public record, you can go and track who's buying in the market, who's listing the properties, who's selling them, and who's gaining the traction. It's pretty easy for anyone to track who's actually converting on the transactions. And in the zip codes that the iBuyers are focusing on are doing north of 25% of the transactions, and sometimes significantly more than that. And what that's doing is it's essentially eliminating the signed brokerage, the family names that we're all so used to. It's eliminating their opportunities within those areas.
It's crowding them out. And the reason this is happening is because these iBuyers are looked at by investors as platforms versus traditional companies. And so they've got so much money because they're getting funded by VCs and private equity groups and so forth, that they're just crowding out, right? And I've talked a lot in prior episodes about the rather dysfunctional way capital formation works in America and really around the world, but that's another conversation for another day. So they're crowding out the traditional brokerages, certainly to an extent, but are they making any money? We really don't know because they're not publicly traded companies. And that sort of leads me to a kind of a not directly related conversation. So dive into this one when you want. But consolidation and dumb money and how a lot of these companies just don't make any money. So you've heard Doug on the show many times over the years. Doug has a great saying, and I'm glad that after 10 years of talking, he's finally become an investment counselor with us, which is super exciting. And one of the things Doug says to me, he has these great, wise little quotes, and he's spoken at several of our events. You heard him if you were at our Profits in Paradise event in Hawaii last month. Doug says, Jason, real businesses make money. Real businesses make money. In other words, they don't just raise money, they actually make money. Okay? And a lot of these companies just don't make any frickin' money. A lot of these big institutional real estate investors with thousands and thousands of homes actually don't make any money either, because they're great at raising money, but that money that they've raised causes a dysfunction in thinking, because it forces them to deploy that capital. They've got to go spend the money or they're not going to get more. And so the metric versus running a profitable business is, hey, let's just have a big business. And then someday maybe we'll be profitable. Sorry to hog the mic. You got a lot to say, I'm sure.
Yeah, no, what's interesting is just like for guys like me, my business has to be profitable. Right. If I'm not profitable, I don't exist because I don't.
Congratulations, you run a real business.
Well, right. So I would love for that to, well, I don't know. I don't even know what to think about that.
I'd love to not have a real business.
Well, yeah. But the point, that just brings us back to the point, is that it's the paradigm shift in understanding what these companies are really doing. And what they're doing is they're not building a cash flow statement. It's not about the P&L. Right. That's not how they operate like the rest of us. They're going for market share. And it's a race to the top, who can do the most, who can become the monopoly within that space, and then it's about the exit afterwards. Mm-hmm. So it's a very, very different mindset. Yeah. And if you trace the incentives, like you talked about having to deploy that capital, right. Well, that's exactly what's going to happen, because these companies are incentivized to deploy the capital.
Absolutely. On the iBuyer component, I just want to say, and I'm not going to mention any names here because, well, I'm not going to mention any names. But I will tell you that a gentleman I had lunch with today here at the conference was talking about how he's got, give or take, 1,000 properties in his portfolio. Okay, and he's what you'd call a large mom and pop investor, but not an institution by any means. And he has, is constantly selling some properties off the line that are kind of some of the sort of dog properties that he doesn't like that much, right, out of his portfolio of about 1,000, give or take. I mean, I have the exact number, but I don't want to say the exact number because I might identify who it is. Okay, so I'm not going to say the exact number, but it's around 1,000. And 1,000 properties. And these are all single-family homes. And basically, to liquidate the dog properties, he gives them to an iBuyer and they buy them. Now that says a lot to me. He says, yeah, my crappy stuff, I just give it to soandso.com. and that's who sells it for me or buys it from me.